all. You are on our Million Dollar Baby webinar. And I'm so passionate about this call because, hey, we are changing generational wealth, right? And just a little bit about myself. My name is Kimberly Howard, and I am a mother of three. And one of the reasons why I'm so passionate about this as well is because I did lose a son, right? So it's so important to protect our kids. And you'll see from this webinar why it's important to put plans for our children. Not, yes, we're building generational wealth, but also to protect them. Okay. So Miss Taylor is going to start it off tonight. Miss Taylor, take it away.
Hello, everyone. Welcome. We're excited to have you. Just as a reminder, this call happens every Wednesday, 9:30 Eastern, 6:30 Pacific. So if you know anyone who's looking to build a strong financial foundation for their children, please let us know. And please let them know to join. And Miss Kim, are you sharing tonight?
Yes, Miss Natalie, can I get sharing? It won't allow me to share. Perfect. Thank you so much.
I'm following you, Kim.
Okay. Can you guys see my screen, you guys?
Yes, we can.
Perfect.
Thank you. Okay, so before we talk about solutions or get into all the great things about the Million Dollar Baby, we first need to understand the reality that most families are facing today. 60 to 70% of Americans are living paycheck to paycheck. Nearly half of Americans cannot afford $1,000 emergency without borrowing money. The average household debt is over $100,000, and college graduates are leaving school with tens and thousands of dollars in student loan debt. And even after working their entire lives, many people are still not financially prepared for retirement. The average Social Security benefit is under $2,000 a month, and most Americans do not have enough saved in traditional retirement accounts to maintain their lifestyle that they hoped for. So, unfortunately, most schools never taught us how money truly works. They taught us how to go to school, get a job, work for 40 years, and hopefully retire comfortably. And so now we're going to go into a video that will describe a little bit more about how the IUL really works and its structure. And we can't hear the audio.
Oh,
So the audio is still not playing.
Kim, yeah, we don't hear it, Kim.
oh no. Sorry, you guys.
You could make me co-host.
Yes, Miss Marlena. Um, can you share your screen?
Go to share. Just click on share, Kim. Can you hear me?
Okay.
Yeah, we got
Yes.
it. Her computer acts up a little bit sometimes.
Yeah.
Thank
Click on.
you.
Okay.
Thank you, Miss Smith.
If you click on share, and then you should have share sound. It'll play.
Of course, my computer does not want to cooperate every time I do this. Miss Marlena, are you able to share for us? Because it's telling me to do a password. Thank you.
A pretty money savvy guy once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." So you're ready to start saving for your kids' future. You already understand the power of compound interest over time, so you know the sooner you start, the better. So where should you be saving that money? Let's talk about perhaps the most powerful and least known savings vehicle for kids on the market, Indexed Universal Life, or IUL. IUL stands out against all other savings vehicles in one main area of strength: flexibility. Other financial vehicles lock you into what you can use your savings on, but an IUL can be a first car, a college education, a down payment on a house, a wedding. IUL cash value can be used however, whenever, and on whatever you choose. Plus, since it's built on a financial chassis of life insurance, your child is instantly covered with hundreds of thousands of dollars of permanent life insurance with living benefits, simply as a side benefit of utilizing IUL as your choice of savings vehicle. Now don't freak out, the fact that it's life insurance is actually a good thing. Life insurance cash value comes with a ton of unique side benefits, like your cash value being protected from market losses, cash value growing tax deferred and being accessible tax-free, protection from lawsuits, and IUL cash value is not considered in asset calculations when applying for student loans for college. So, what could one of these policies look like for your kiddo? Let's say you had a baby today, and to take maximum advantage of the power of compound interest over time, you immediately start socking away $100 per month into an IUL. Right away, your child is now covered with $371,000 of permanent life insurance coverage with living benefits. That's a pretty nice little side benefit. And that financial foundation you establish for them today will continue to grow with them over the years and be available throughout their lifetime for whatever they need or want to use it for. Plus, if they don't access that money, right around retirement, their IUL is conservatively projected to hit $1 million of cash value. And at age 65, they could turn on a tax-free income stream of $75,000 per year that will last them the rest of their lives, no matter how long they live. The point is, they have options. IUL is the most flexible savings vehicle for children on the market, and the best time to plant that seed is today.
Okay, so now we're going to talk about what the $1 Million Plan is, right? So the $1 Million Baby is a strategy built around the Indexed Universal Life policy. Now, when people hear life insurance, they often think about death benefits, but today's IULs do so much more than that. It's designed to provide the life insurance, but also while building cash value over time. The cash value grows based on the performance of a market index, so such as the S&P 500, while still protecting against market losses through built-in safeguards. And uh, it's okay. One of the major goals of this strategy is to create lifelong financial benefits for the child. So that includes tax advantage growth, death benefit, and ability to borrow against the policy for major life expenses. So the top 3 benefits of the $1 Million Baby. So number one, time and cash value growth. So with the cash value growth, a parent, grandparent, or legal guardian can open the IUL policy. Premiums are paid into that policy, which grows in the cash value based on the indexing strategy. And next, excuse me, what is an index interest strategy? So there's 3 ways that money grows. The first is fixed. So that's where you have a guaranteed interest rate. It's low risk, predictable growth, and limited upside. So you get a small growth and it does not keep up with inflation. The second is variable. So it's directly tied to the market performance. It's the highest growth potential that you could get, but also the highest risk. So you can lose value during market turndowns. And indexing, so you get the best of both worlds with this. So it's linked to an index like a S&P 500. It's not directly invested in the market, but you do get opportunity for growth and protection from market losses through the zero floor protection. Next, we have tax advantage, right? So taxes can have a major impact on wealth accumulation. It's not just what you earn, it's what you keep. So cash value grows tax deferred, meaning you don't pay taxes on the growth as it occurs. Your child can later access the cash value tax-free through policy loans, such as education, home purchases, or retirement. So next, we're going to talk about wealth transfer and legacy. Your child can continue funding the policy as an adult. The cash value can continue to grow for decades, and your beneficiary will receive a tax-free death benefit when that time comes. And this is a potential multi-generational wealth strategy. So now comparing saving options for kids. So you may already be using a 529 plan or even a brokerage account through your bank. All of these accounts have after-tax contributions, and the 529 plan offers tax-deferred growth, tax-free distributions, and market growth potential, which is great. But taking a closer look at some of the areas where the $1 Million Baby Plan stands out. So first we have no market risk. So with traditional investments, your money is subject to market ups and downs. In contrast, this plan protects your principal. So you never lose money due to market decline. So just remember, zero is your hero. Next, we have tax-free liquidity. So you can access your funds here for tax-free, whether it's the death benefit, accumulated cash value, or living benefits. No one likes to pay taxes, right? So if you can place your money in a plan that allows it to grow and be accessed without increasing your tax burden, that's a major advantage. Your after-tax dollars continue to compound and grow, all while you're giving the ability to access funds tax-free when needed. Next, we have freedom of use. So unlike a 529, which must be used for approved educational expenses, this plan gives your child the freedom to use the funds however they choose. So once again, whether that's college, starting a business, or buying a home. So when they say educational purposes, it typically refers to college or university expenses. So if your child wants to pursue a trade, go into entrepreneurship, or take an alternative path, they cannot use the 529 plan without penalties. So if your child doesn't attend college, the funds can be transferred to another child or family member, but if not, you will be taxed and penalized on the money that you've worked so hard for. Now, next we have insurance benefits. So this plan includes life insurance. It's backed by the IRS codes that support tax-free growth and distributions. It's much more than just a savings account. And last but not least, we will talk about financial aid. So it does not affect financial aid. When applying, traditional accounts like 529 or brokerage accounts show up as assets, which signals the system that you have money available for college. So this can reduce or eliminate your eligibility for financial aid. And the wealthy have long used the IULs to store and grow money in a way that doesn't penalize them, right? So this plan is not treated as a reportable asset, making it a smart strategy for college-bound families and protects generational wealth. And now I'm going to turn it over to Ms. Kim, and she's going to talk about the benefits of the $1 Million Baby.
Thank you, Miss Taylor. Amazing, right? Like we can really set up our kids and have them a personal pension, right? People that we meet, they cannot retire on time because, Social Security is not enough. So there is so much benefit with starting early. What our children have is time. So here are the benefits, right, into starting a $1 Million Baby plan using an IUL, as Miss Elena Taylor mentioned, the tax advantage growth, right? The cash value grows without immediate taxation. Market protection. I love this because I don't like losing money, you guys. And there's some, right, like our 401ks. If the market goes down, you have the ability to lose money. So as Miss Taylor mentioned, the index funds, right? There zero, I always say, is your hero. There's a floor to prevent your losses. 3, the legacy and death benefit. One thing I always say, you guys, that's guaranteed is 1, we all got to pay taxes, and 2, we all gonna pass away one day. So setting these up early can build generational wealth for future generations, right? 3, the flexibility, access to funds. As Miss Elena mentioned, right, the 529 plan is only used for educational purposes. So if, let's say, your child has a scholarship or opens up a business, right, they will incur fees if they use that for other things, or they can transfer it to another person that wants that uses that for education. But with the IUL, it's more flexibility. Loans can be taken out tax-free for major life events and expenses, right? And the contributions will come back to you one way or another, which I will show you with my son's policy, right? It has the cash value growth. God forbid something happens. It has what's called living benefits, which I will go over. And the income, let's say you wanted someone wanted this as an income strategy later down the line, that you're able to structure these, right? A way where your children, their goals, okay? And then obviously the benefit, God forbid something happens to them, they leave an inheritance to the next generation. So there's a quote here, it says, how do I set up how do I set up $1 million baby plan for my child, right? So you guys heard all the benefits, but the first one is really choosing a reputable insurance company. Look for an insurer with long financial ratings, A or higher, and favorable IUL products for children. So the companies that we work with, they've been around for over 175 years, right? So they've been through the recession, depression. So you want to make sure that you choose a reputable insurance company when looking at these type of plans. 2, you want to structure the plan properly. Okay, so that's where we come in. We are licensed professionals that are able to structure these properly for the child, right? And for the parent. So the parent and guardian owns the policy first, okay? And the child is the one that is insured. So we help you choose a coverage and funding strategy that really maximize long-term cash value growth that aligns with your goals. So that's so important to get back with the person that got with you today, because we do what's called a financial needs analysis. We really want to understand, what are your goals, what are your goals for your children, are you currently saving, what is the budget looks like, right? So we help you through the process. We want to help you understand the growth and protection features, right? Miss Elena Taylor mentioned the index, right? The market index growth potential. An example is S&P 500. There are also other indexes that we use, the U.S. Pacesetter. So there's different indexes that we can look into to kind of see what is getting the most return at that particular time. Because what we do when you are a client with us, we review this actually every 6 months to see what the market is doing and to see if any of the goals has changed. So we are with you every step of the way. So the downside protection with cap and floor strategies, tax advantage loan and withdrawal options, and then the optional riders for future insurability and long-term care, right? And the other one is, you know, apply and fund the policy. That's the next step. So minimal underwriting for most children. Usually they get approved right on the spot or within 24 to 48 hours. If they do have a medical concern, then usually it takes weeks, right? But children is so easy to approve. And you want to begin funding early. This is why you want to utilize these type of investment, because of the compounding growth. The earlier that you start, the better it is for your child as it grows. So I will show you an example. And then the policy ownership, right, can be transferred to the child in the adulthood. So if you teach your child how to continue to save up for them, Or there's also ways to structure these where sometimes the grandparent want to use just pay 10 years, right? But they want to make their money compound for them. You can definitely do that. That's where we come in to really help you structure these type of policies. There's a quote here. It says, train up a child in the way he should go, even when he is old, and he will not depart from it. That is so important because it's our job too, as parents, right, grandparents, to help our children understand how money grows, right? This is where the education part comes in, okay? Um, and I'm going to show you an example of my son's policy. I actually have 3 of these because when I first started the industry, when someone has taught me about this, there was no living benefits for children. Okay. But I saw the growth of them like, hey, this is making more than what it's making in the bank, right? More than my high yield savings. So me and my husband, we opened this. At that time, my son was 9 years old. We're like, hey, we could put an extra $50 a month. That equals to $100 a month. God forbid he passes away tomorrow. We never want to, think about it, but it happens, right? It happened with my family. Here, it's 186,000 that the family receives if he dies too soon. But if he lives too long and he needed the cash, okay, this is where the $1 million concept comes in because mom and dad starting $100 a month. Okay, we structured it differently, but we started with 100, right? At 69, you guys, he has $1.9 million in this account, and it continues to grow over time if he doesn't touch it, right? And that this is more for a legacy for our family. This is building generational wealth for our family because we have other policies from him, but this is Mr. Start Early, okay? We started him early. Um, and I'm going to go in detail about the cash value and what they can utilize it for. But also, if we go back, Miss Marlena, another important part is what if they become ill? Right? I work for Adult Protective Services, and one thing I always see is that people have big retirement accounts, but if they got sick, right, they had a stroke, they had a heart attack, they had to deplete all of their retirement funds. Some people even had to put up their home because they needed a higher level of care. And I'm here in California, and assisted living is minimum $10,000 a month. So imagine needing that money and draining out your accounts because you need a higher level of care, right? But if you had something in place like this for yourself or your children, you are already setting them up to protect their assets, to protect their income. Because at 65, as you see here, if he was diagnosed with a terminal illness, he's able to take out 1.5 lump sum. If he had a chronic illness, this is if he lost 2 of his activity of daily living, right? This will pay out $30,000 a month. So that would cover that assisted living, critical illness benefit up to $1 million, critical injury up to $1 million. And they just added this Alzheimer's because Alzheimer's all-time high right now. People that who have Alzheimer's, they need higher level of care, right? And it's so expensive. So these are the living benefits now that are here with this company that you're able to take out in case you needed it. So let's look how I structured this policy for my son. So me and my husband, we said, hey, the first 5 years, we can do $100 a month. We know that we're going to get raises, right? We have a business, so we know we're going to get more income. But after 5 years, we're going to increase that to another $100 a month. Okay, right? Where the more that we put, the more that we're able to get into savings, right? And then at age 19, we're going to show our son how to put his money into this type of plan and put an extra $200 a month with um, our investment. Okay, so here we're gonna say he's gonna stop it at 45 years old. Okay, we have contribute $147,000 in this plan. And basically that 147 became around 412,000. Okay. And that is protection from the market. Okay. And if he keeps this, he doesn't take from it, right? This is something that he's building. um, this is $1 million asset. So as he continues to hold on to this policy, that at age 60, he has $1 million in this account, right? That 147 just became $1 million. Now, where can you find a place where it's safely, right, going to compound over time and make that asset $1 million, right? So as he continues to grow, right, he's not taking money from this policy, but this is a generational wealth building for him. At age 80, okay, he has $3.9 million in this account. And God forbid he pass away, this is where generational wealth comes, right? He leaves $4.1 million to the next generation. Miss Taylor, I always ask this question. Do you know your great, 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 great grandfather, grandparents, actually?
No, I do not.
Because they didn't leave her any money, right? I mean, if you started this for your grandkids or your children and you left $4 million, they would definitely have a picture of Miss Taylor right on the top of her fireplace, their fireplace. So this is how people build generational wealth because one, for kids, they have time, right? They have a lot of time to make their money compound. But two, as you increase your investment, right? We increase from 100 to $400 later on, that it can potentially, it'll be $1 million asset. Okay. So another, structure, because remember, there are different ways to structure these things. We call this AKA Mr. Start Late. So what if you didn't have a child? Now they're a young adult, right? Now they want to say, hey, mom, I want to start saving now, right? I have a great job. What can I do? Okay. So this person, they started off with $150 a month. Okay. If they pass away tomorrow, they have the same benefit. God forbid, 167,000. But this one was structured a little bit differently, right? They say, hey, Social Security is going to be obsolete by the time I retire. He says he wants to create a personal pension for him where he can get a um, lifetime income from this investment. Okay. As you see here at age 70, does anyone know, okay, from Social Security, what is the maximum benefit, okay, that you can get from Social Security? Does anyone know? Okay. All right. So the maximum benefit, you guys, depends on the age when you retire. Okay. If you retire at age 70, and this was last year in 2025, your maximum benefit would be $5,108. But in order to qualify for the maximum, you must have worked at least 35 years, okay? And you have to earn the maximal taxable wage, which is in 2025, it was $176,000. Okay. And you have to wait until age 70 to claim your Social Security benefits. Isn't that crazy, you guys? You work all your life to make six figures to make $5,000, right? But hey, what if you create your own Social Security. So here, my colleague, she structured this as what if he start taking income out at Social Security age? What would that look like? It pays them $6,579 a month. That is more than Social Security if he was to choose a lifetime income rider. Okay, meaning that it will pay for him for the rest of his life. He will all have all the benefits as you see on the bottom, like I explained, right? So I'm not going to go over that, but let's look how we structure this policy. Okay, so my colleague, um, the client said, hey, I could start off with $150 a month. Then he wants to increase it in year 4 to $3,000 a year, which is $250 a month. Okay. So he added an extra $100, but then he wants to continue to increase it. And then let's just say at age 35, where he's going to maximize this fund. Okay, he's gonna put $6,000 a year, which is $500 a month, because that's how much, on average, people put away for their 401k, right? They put about $500 a month for their 401k. But look, he's gonna stop contributing to this thing at age 57 years old. Okay, so he has contributed $181,000 into this account, and he's going to wait to take money out of this account at age 70, right? When Social Security, we wanted to compare it to Social Security, and he says, hey, I want to take it out at age 70. What would that look like? So his income will be 78,948 a year. Okay, for the rest of his life. So even if he lived up to 120 years old, because these policies go up to 120, people are living longer. Okay, next page. Let's just say at age 92, God forbid he passes away. He has taken out $1.8 million in this plan, and he only has contributed 181,000, and he still leaves a benefit to his beneficiaries 148,000. Isn't that amazing, you guys? Right? Because he started this plan, he creates a personal pension for himself. We can do that. The younger they are, the better it is, right? And the obviously, the more money you put in, the more accumulated cash value it'll become. So as you see here, this illustration goes up to 120 years old. I think the oldest person right now is like 115, 16, somewhere around there, right? But if he took this out for 120, he took out $4 million and he only contribute 181,000. He still leaves 88,000 to his family. So these are the power of starting an IUL for your kids. Why start early, you guys? Because it's lower monthly right now in total contributions. As you see for my son, we only started off with $100, right? As we increased it. But there's more years of compound growth. That's the main thing. They have more time to make their money work for them. Okay, greater long-term cash accumulation, as you've seen on both of these strategies, that these can accumulate to $1 million, right? Asset, just as long as it's structured correctly. Okay, future financial flexibility. So if my son needed the money for his business, he's able to take that out tax free, right? And it has a lifelong insurability, meaning that no matter what, that, hey, just as long as there's money there and their benefit, right? They have a benefit that, God forbid, something happens to them, they leave something to the next generation. So time here matters more than money. right? So if you have kids, definitely get them on this because this is how people build generational wealth. All right. So, what are your next steps, you guys? Get back to the person who invited you today, right? Let them know, set up an appointment to really structure a plan for your children because there's different ways on how to strategize these things, right? It's not a one size fits all. We really listen to your goals, your children's goals, right? How you're budgeting, things like that, but let's help you create your $1 million baby and refer any parents, grandparents who would love to start saving for their children and grandchildren. We do this webinar every single Wednesday, 6:30, right? Just to provide education to our families, our communities, because it's so important to spread the word, right? So that we can really set up our next generation the right way. So I appreciate your guys' time. Thank you for being with us this evening. And we look forward to seeing you on the next one. Thank you, everyone.